Today, we're tackling a really interesting puzzle. A lot of investors are kind of scratching their heads over this one.
Yeah, it's about Warren Buffett's Berkshire Hathaway, right? And Apple.
Exactly. Why they've been steadily, trimming that massive Apple investment all through 2024.
It's a big move.
It really is. So our goal for you today, listener, is to see if this actually makes sense when we, well, stack Apple's fundamental numbers against some of Berkshire's other big holdings.
Right.
Okay, let's get into those details then. Looking at the value, we've got that data in front of us. The drop in the Apple stake value in 2024 is, well, it's pretty dramatic.
Huge numbers.
We're talking a fall from, what, $135.3 billion in Q1?
Mm-hmm.
Down to around $75.1 billion by the end of Q4. That is a huge chunk of change.
A massive reduction. And the share count itself tells an even clearer story, I think.
How so?
Well, Berkshire went from holding nearly 790 million Apple shares back in Q1 2024
Right.
to just 300 million by Q3 and Q4.
Wow, less than half.
Exactly. And to really put that in perspective, think about American Express, another major holding.
Okay.
Their share count in Berkshire's portfolio, rock solid, stayed at about 151.6 million shares all year long.
Ah, no change there.
None.
Right.
That difference, I mean, it really points to a deliberate, significant decision about Apple specifically.
So the billion-dollar question, right? Why? Let's start with valuation. How the market values these companies.
Good starting point.
A key metric is the price-to-earnings ratio, the PE ratio. As of late April 2025, Apple's PE is 33.22. Now, maybe just quickly, for listeners, what does that PE ratio tell us?
Sure. It basically shows how much investors are willing to pay for each dollar of a company's earnings. Simple as that.
So higher means more expensive or maybe higher growth expectations.
Exactly. A higher number can suggest higher growth expectations or just that the stock is perceived as expensive relative to current earnings. And what's fascinating here is comparing Apple's PE to some of Berkshire's other big names.
Let's hear it.
Okay, American Express PE of 18.48, Bank of America 11.85, Chevron 14.27, Coca-Cola is 29.23, so closer but still lower.
Right.
Even Moody's, which is actually higher at 37.88, and Occidental Petroleum at 17.86.
Yeah.
It shows Apple's valuation based on PE is definitely on the higher end within this group.
So for a value guy like Buffett?
Well, yeah, for a value investor, a PE significantly above the average of his own portfolio might just signal that, future returns could be lower. It might make other holdings look relatively more attractive.
That makes sense. A higher price relative to the earnings might mean it's, well, overvalued or at least less of a bargain.
Could be.
So let's dig into the revenue trends. Does Apple justify that premium?
Let's look. Annual revenue 2021 to 2024.
Okay, Apple's numbers, $365.8 billion, then up to $394.3 billion in 22. But then a dip in 23 to $383.3 billion, and then a slight recovery to $391 billion in 24. Let's get even more granular, the actual year-over-year growth rates for revenue.
Good idea.
Apple had a solid 7.79% jump in 2022, but then it actually shrank by 2.80% in 2023, followed by just 2.02% growth in 2024.
And compare that to AXP.
Let's hear it.
American Express posted consistently positive and, frankly, pretty strong growth rates. 22.52% in 2022, 14.48% in 2023, and still a healthy 8.98% in 2024.
Wow. Okay. That's a very different picture.
It's a stark contrast, isn't it? Apple's slower pace, even negative growth one year. It suggests that Apple, despite its huge size and brand, might be finding it harder to achieve high growth compared to Amex within that same portfolio.
That makes a lot of sense. Okay, growth is one thing. What about profitability? Earnings per share, EPS.
Crucial metric.
From 2021 to 2024, Apple's EPS was $5.61, then $6.13, and then a slight dip to $6.08 in 2024. Looks pretty stable maybe, but not exactly setting the world on fire growth-wise.
Right. And EPS, just to remind everyone, is simply the company's profit divided by the number of shares, how much profit each share theoretically earns.
Got it.
And like you said, while Apple's EPS is certainly respectable, very healthy in absolute terms.
Yeah, $6 a share is good.
It is. But the lack of significant growth, and especially that small decline in 2024, that's noteworthy in this comparison.
Okay, so how does Amex look on EPS?
The more compelling growth story there, recently anyway, $10 in 2021, a little dip in 22 to $9.85, but then a solid climb to $11.21 in 2023,
Ah.
and a big jump to $14.33 in 2024.
Okay, so definite upward trend there lately.
Definitely. And Moody's also shows strong EPS improvement by 2024. So yeah, Apple's profitable, no question, but its EPS growth just doesn't look as robust as some of these peers in the Berkshire family.
Okay, one more metric, financial health. Let's use the assets to liabilities ratio.
A measure of solvency, basically.
Apple's has been pretty consistent, right? Hovering around 1.17 to 1.22 between 2021 and 2024. Seems solid, indicates a decent financial footing.
It's definitely solid.
Yeah.
An assets to liabilities ratio above 1 means the company has more assets than liabilities. Apple is clearly financially sound.
But how does it stack up against the others in Berkshire's stable?
Well, what's interesting is that while Apple is sound, some peers show even stronger financial leverage, or perhaps a bigger safety cushion, by this specific metric,
Like who?
like Chevron. Their ratio was consistently well above 2 during this period.
Okay, twice the assets compared to liability.
Right, and Occidental Petroleum stayed above 1.35. So while Apple's 1.2-ish is healthy, it just suggests some others in the portfolio might have a more substantial financial cushion, at least based on this particular measure.
Got it. Okay, let's try and wrap this up. If we step back, look at the whole picture, our fundamental analysis seems to, well, lean in a certain direction,
What's the takeaway?
particularly looking at Apple's valuation, that higher PE ratio,
Uh,
the somewhat inconsistent revenue growth trends and rates,
right, the dip and slower growth.
and maybe most importantly, that lackluster EPS growth compared to some key Berkshire counterparts like Amex.
Yeah, that really stands out.
It does appear to support Berkshire Hathaway's decision, doesn't it, to significantly cut back that Apple stake during 2024.
It does look that way.
Mhm.
It's like we're building a case using the public data, just like maybe Buffett and his team did. Do the numbers justify the big sell-off?
And the answer seems to be maybe yes.
Based on these key financial metrics, yeah, it seems plausible that Apple's performance and valuation just weren't looking as attractive as some other opportunities within Berkshire's portfolio at that time.
The data suggests the move could very well be grounded in a fundamental rethink of Apple's investment appeal relative to other things they own or could own.
Exactly.
Now, of course, we have to remember this analysis is just based on a specific set of financial indicators, numbers on a page at a point in time.
Absolutely. There could be other factors.
For sure. Other strategic things driving Berkshire's decisions that, aren't immediately obvious just from these metrics.
Like what?
Well, maybe portfolio diversification goals. They had so much Apple stock, maybe it was just too concentrated.
That's a classic reason. Or just simple profit taking. They made a fortune on Apple.
Absolutely. Cashing in some chips after years of huge gains. Or maybe they identified totally new investments somewhere else that looked even better long term.
All possible.
Yeah.